So we'll start off with the obvious. NVIDIA reported results tonight. I didn't really think they were anything special. They pretty much came in, as we sort of thought they would over the weekend. When I had noted, I thought revenue would probably be around $40 billion and they would guide to around 42.5. They came in at 39 and change, and they guided to about 43. So, give or take, pretty much as expected based off of what they've been doing consistently now for about 7 quarters in a row. And you can see the stock is trading a little bit lower following the results, under 130, around 129 and change. So, clearly there's a lot of positioning that's going to be going on around this thing tomorrow. So we're just going to move on and talk about some other stuff. S&P 500 today did manage to finish the day flat. We had traded all the way up to 6,000, and then we sold off into the end of the day. Obviously, we had NVIDIA reporting tonight. There was some more talk of tariffs. We did see the VIX one-day rise pretty dramatically, closing the day up at 20.5 into NVIDIA's results. And it's not unusual to see that happen. The market treats NVIDIA as a very big deal when it comes to these results, just because of how important it has become in the indexes, and also because at the end of the day, it contributed to a very large portion of the market's gains overall last year. And so obviously this is going to have a major impact on equity prices. And so what's likely to happen tomorrow, just like every other event, once that event risk passes, we can probably expect to see the VIX one day actually open significantly lower. And, that could give us sort of a start of the day rally. Of course, where that rally starts from is really the important thing, because you can see as of right now, futures are trading a little bit lower after hours. And, again, once the market opens and volatility resets, we could see a sharp rally, and that may only be given back as the day progresses. But really what's more interesting, I think, is really what's happening in the bond market, because we've seen rates really continue to fall, and I'm a little bit surprised by how much they've declined, to be honest. I have certainly been in the camp that we were going to see a higher for longer Fed rate policy. I thought inflation could potentially reaccelerate. But more interestingly, now all of a sudden the bond market has really started to sour, and you've seen rates really come in pretty dramatically. In fact, we've seen rates now fall for about 6 days in a row, with the 10-year coming down from around 455 on the 19th to close today at 427. So right now we're looking at about a 25 to 30 basis point decline on the 10-year. Really, a lot of this started last Friday following that S&P Global report, and then the University of Michigan numbers, which showed inflation expectations have really just gotten out of control. In fact, what you have here is the University of Michigan and the Conference Board's inflation expectations for 1 year. And these numbers have really skyrocketed. The Conference Board's numbers were up to a 6% 1-year rate, and the University of Michigan numbers jumped from a 3.3 to a 4.3. And, obviously there's a big gap between the two. It looks like we usually run at about a 1.5 to 2% gap between the two. But more importantly, it's the direction and the velocity of the direction. We've really seen consumer-based expectations really rise. And what's also more concerning here, really, when you look at it, is you've seen long-term inflation expectations rise as well to their highest level since 1995. And so this is a very important level for anyone that's been following this channel now for some time. We've talked about the University of Michigan numbers and how important this 3.1 to 3.2% level has been. And we just totally blew right through it in February, going up to 3.5. And so we've seen this really big move up in inflation expectations. And this is what sort of triggered this whole thing. And now all of a sudden you've seen bond rates come down. And that sort of leaves you to believe, what is the market really thinking about here? Is the market really getting concerned now that the Fed's not only not going to be able to cut rates because inflation expectations are rising rapidly, but is the tighter monetary policy now going to lead to slower growth at some point in the future? And that's really yet to be determined, and there's certainly reasons to think that may not be the case. One reason why I think the growth scare that we're kind of getting right now may be a little bit overblown is that when you look at the Indeed job postings, what we've actually seen is this kind of stabilized really over the last couple of months. And so it doesn't really look like the job market is weakening materially, or that the number of job openings has really started to deteriorate further. It's actually just kind of trading going sideways now since the middle of October. Yes, I mean, we did certainly see the same thing throughout May and from May through October, but it looks like at this point, at least, we've kind of come off the lows and we've kind of stabilized a little bit, and it will be interesting to see how this continues to develop. What this would suggest, though, is that the JOLTS data that we're going to get not next week, but the week after, it looks like, based on the calendar, should also continue to be fairly solid. And we look at actual estimates for the job report that's coming at the end of next Friday. You can see job estimates are around 133,000 for the month of February. We're looking for the unemployment rate as of right now to remain fairly static at around 4.4%. Average hourly earnings to remain around 0.3. The work week is expected to improve a little bit. When we look at ISM non-services, we're looking for it to increase to 53 from 52.8. And we're looking for manufacturing to remain above 50. So these numbers don't really scream of the economy is slowing dramatically and everything is kind of getting out of control. And you can kind of take that one step further and you go and you look at the parts of the market that really kind of start screaming when we're starting to see things deteriorate. And that would be credit spreads. And credit spreads have gone up a little bit, but they're still very, very tight. And so despite the fact that we've seen 10-year rates come down really sharply, we haven't really seen any changes in a dramatic fashion in high-yield credit spreads. And for that matter, you haven't even really seen them change in investment-grade credit spreads. So what this is kind of implying to me is that a lot of this may actually just be some nervousness that's been surfacing in the marketplace, but it's not really showing up in the parts of the market that are really sensitive to changes in the economic outlook. And one way you can really just keep track of this is by looking at something like the HYG. I mean, the HYG, believe it or not, when you adjust it, is trading at an all-time high, and it certainly doesn't look to me like the market is very worried about, rising default rates or any sort of recession. It would be showing up in something like this, I would think. And so it makes you think about, what's really going on here in the 10-year, because that's clearly not what the rest of the market is showing you. And the fact is that, yes, we've seen the dollar come down and we've seen it kind of but, when you look at the dollar and where it is, it's really only at the 38.2% retracement level. It has what looks to be a falling wedge in it, and it looks to me like it's getting ready to break out and go the other direction. I mean, when you look at the euro just can't really get above 105, and every time it gets to this area, that's basically where it stops going up and stops strengthening. And it looks like the euro is getting ready to really make a break lower. And so, when I look at these things and I look at the Canadian dollar, that's also been starting to show signs of rebounding again, sign of a stronger dollar. When we look at the Japanese yen, that really hasn't been able to break down below 149.5. And so what I think may actually be happening in the 10-year rate, now that I continue to think about things and go through it, is you're just seeing, weakness globally really taking hold. You can see the German 10-year has moved down pretty dramatically. They had big elections there over the weekend. You've seen the Italian 10-year move down. But more importantly is you've seen Japanese rates really move down sharply. You've seen the Japanese 10-year move down from around 146, and it actually got as low as 133 just last night. Now, tonight is starting to rebound a little bit. Basically, we had really hot CPI data in Japan, and the Japanese 10-year looked like it was getting ready to run away, and then the head of the BOJ comes out, Governor Ueda, starts talking about the potential for maybe the BOJ stepping back in at some point, resuming bond purchases if the market really starts to get disorderly, and that, of course, sent Japanese rates lower across the curve. And the other thing that we've obviously been keeping an eye on is the Chinese 10-year. The Chinese 10-year has actually started to go up a little bit. And what's really interesting about the Chinese 10-year, when you started to see the Chinese 10-year really decline, that was when you started to see the U.S. 10-year go up. And now you're seeing the U.S. 10-year come down, and you're seeing the Chinese 10-year come up. And it almost looks like there's something going on potentially there as well, with these two markets working against each other. Or perhaps you've been seeing something going on with China and the way they've been conducting their own policy. But what it looks to me like is that there's something maybe going on a little bit more here than just the typical we're getting nervous about growth going forward. And it could really be more about, something mechanical going on in the marketplace. And it's not really clear at this point that we are really seeing these growth deteriorations, at least when you look at high yield credit spreads, when you look at what the economic data is expected to come in at over the next week, which is going to be very important data points. I mean, and to this point, really the only bad data we've gotten is retail sales, and we've gotten some weak services data out of the S&P Global PMI data points. But the manufacturing report actually came in better than expected and was much stronger than last month. And, so we'll have to kind of see, because remember, this was the flash data point that came in. And this is only about 85% of the companies are actually reporting at this point. And so we'll have to really kind of just see how things shape up next week. But based on what I'm seeing, I get the feeling that there really isn't a growth scare out there, but there's something else going on. And that when the data starts coming in next week, we're going to see the market reevaluate what it's thinking about in terms of where 10-year rates are. I could be completely wrong, but that's just based off of what we're seeing, because I would think that if there really was a growth issue, you would really be seeing the dollar weakening material. We'd really be seeing credit spreads widening out. And at least to this point, we're not seeing that yet. Anyway, I hope you enjoyed this video. Please remember to share it with your friends. And also, please remember to subscribe to this channel and like this video. Please remember to help me grow this channel out in 2025. And we'll see you again soon. Bye.